first of all, look at the supply-demand, I suppose, dynamic here. On the one hand, supply is remaining pretty constant, but on the demand side, we've got two aspects here. The possibility of a recession, and on the other hand, the China reopen. So this is, I suppose, where the battleground is.
Sure. Look, we think oil market is not prepared for any sequential demand growth because supply isn't really growing this year. If you look at China, we think the China reopening will drive from now until the year end 1.6 million barrel per day demand growth in oil. Now, for context, oil market is about 100 million barrel per day globally. And typically demand in a normal economic environment grows 1 to 1.5 million barrel per day. So in that context, China reopening with 1.6 million barrel per day of sequential growth is quite meaningful, especially when supply isn't really growing because of the underinvestment we have seen over the last few years in the oil assets. So we see crude heading, Brent heading into $100 per barrel oil by third quarter this year with the China reopening, while we also see the downside protected because OPEC is back with the pricing power and they're going to control the supply to ensure oil prices are 80 or higher. So we have a high conviction on 80 to 100 oil range in the reopening.
Nikhil, what's the impact of the EU and its price cap on Russian oil? I mean, does it really move the dial? I mean, let's be fair here. And also, all these predictions of a dire energy crisis in Europe have been perhaps salvaged because of the mild winter thus far.
Yeah, sure. So actually, in our conversation with investors, the focus is moving from the Russian price cap to the Russian product embargo, which is coming on 5th of February. Now, for context, diesel exports from Russia account for 15% of global diesel exports, and 80% of that has been until recently going to the European market. Now, in case of crude, the flows have redirected, but in case of product, India and China are also net exporter of diesel, so the redirection can be more disruptive for the energy market compared to the crude sanctions we saw back in November last year. Now, this is also, I would like to emphasize, this is also happening at a time when the global diesel inventories are already very tight. We have closed 4% of global refining capacity from our tracking since the pandemic started, while we are returning to the normal oil demand growth. So we already have a tight setup for refining margins, but on top of that, the 5th of February product embargo could be more disruptive to the product prices, not necessarily crude, but to the product prices by way of higher refining margins of diesel.